Hey everyone, welcome back to the channel. This is your one-stop shop for everything stock market, education, analysis, and strategies to help you build real wealth. Today's video is all about the mistakes, the ones that cost new investors thousands of dollars, shake their confidence, and sometimes even push them out of the market entirely. But here's the thing, every seasoned investor has made these mistakes. I've made some of them myself. The key is to learn from them early, avoid repeating them, and build a mindset that sets you up for long-term success. So let's break down the most common investing mistakes, one by one, with real examples, practical advice, and some hard truths. This is going to be a deep dive, so settle in. Investing without a clear plan or goal. Let's start with the foundation, investing without a plan. This is probably the most widespread mistake. A lot of people hear about the stock market from friends, social media, or the news and think, I need to get in on this. They open a brokerage account, throw money into a few stocks, and hope for the best. But hope isn't a strategy. Before you invest a single dollar, ask yourself, why am I investing? Is it for retirement? A house? Financial independence? Passive income? Each goal has a different time horizon and risk tolerance. For example, if you're investing for retirement 30 years from now, you can afford to ride out volatility. But if you need the money in 3 years, you should be much more conservative. Without a plan, you're just reacting to market noise. You'll chase trends, panic during dips, and miss opportunities. So write down your goals, define your timeline, and build a strategy around that. It's not sexy, but it's powerful. Trying to time the market. Next up, trying to time the market. This is a trap even experienced investors fall into. The idea is simple: buy low, sell high. But in practice, it's incredibly difficult. The market is influenced by thousands of variables: economic data, interest rates, earnings reports, geopolitical events, even tweets from influential figures. Let me give you an example. In March 2020, when COVID hit, the market tanked. Many investors sold everything, thinking it would get worse. But within weeks, the market began a historic rebound. Those who sold missed out on massive gains. On the flip side, some people waited too long to get in, thinking prices would drop again. They missed the boat. Instead of trying to predict short-term movements, focus on consistency. Dollar cost averaging, investing a fixed amount regularly, is a proven strategy that smooths out volatility and removes emotion from the equation. Timing the market is tempting, but time in the market is what builds wealth. Overconfidence and lack of research. Another big mistake is overconfidence. New investors often think they've found the next big thing. They hear a stock tip, read a Reddit thread, or see a flashy YouTube video and jump in without doing proper research. But investing isn't gambling, it's analysis. Take the time to understand the company. What's its business model? How does it make money? What are its competitors doing? What's the financial health of the company? Look at revenue, profit margins, debt levels, and cash flow. If you can't explain why you're buying a stock in one sentence, you probably shouldn't be buying it. And don't just rely on headlines. Dig into earnings reports, listen to investor calls, read analyst opinions. The more informed you are, the better your decisions will be. Lack of diversification. Let's talk about diversification. Many new investors fall in love with a single stock or sector. Maybe it's tech, maybe it's crypto, maybe it's EVs. They put all their money into one area and hope it takes off. But when that sector crashes, their entire portfolio suffers. Diversification is your safety net. Spread your investments across different industries, asset classes, and even geographies. That way, if one area underperforms, others can balance it out. Think of it like a team. If one player has a bad game, the others can still win it for you. And don't forget about asset allocation. Stocks are great for growth, but bonds, REITs, and even cash have a role to play depending on your goals and risk tolerance. Emotional investing, fear and greed. This one's huge. Emotional investing. The two biggest emotions in the market are fear and greed. When stocks are rising, greed kicks in. You start chasing gains, buying at the top, and ignoring fundamentals. When stocks fall, fear takes over. You panic, sell at a loss, and swear off investing. But here's the truth: the market moves in cycles. There will always be ups and downs. The key is to stay rational. Create rules for yourself. Maybe you only sell if a stock drops 25% from its high and the fundamentals change. Maybe you rebalance your portfolio once a year, no matter what the headlines say. Discipline beats emotion every time. The best investors are calm, patient, and focused on the long term. Chasing penny stocks and get-rich-quick schemes. Let's talk about penny stocks. They're cheap, exciting, and often come with promises of massive returns. But they're also incredibly risky. Most penny stocks are thinly traded, poorly regulated, and tied to companies with shaky fundamentals. New investors often chase these stocks thinking they'll turn $500 into $50,000. But more often than not, they lose everything. If a stock is trading under $1, there's usually a reason. Instead of chasing hype, focus on quality companies with real earnings, strong leadership, and a competitive edge. And beware of pump and dump schemes. If you see a stock suddenly trending on social media with no news or earnings behind it, be cautious. It's often manipulated by insiders looking to cash out. Ignoring fees, taxes, and account types. Another overlooked mistake is ignoring fees and taxes. Every trade can come with commissions, and every gain might be taxed. If you're not factoring these into your strategy, you're losing money without realizing it. Learn the difference between short-term and long-term capital gains. Use tax-advantaged accounts like Roth IRAs or 401ks when possible. And be mindful of expense ratios in mutual funds and ETFs. These small percentages add up over time. Also, understand the types of accounts you're using. A taxable brokerage account is different from a retirement account. Each has its own rules, benefits, and limitations. The more you understand, the more efficient your investing will be. Overtrading and impatient new investors often feel the need to do something. They check their portfolios daily, buy and sell constantly, and chase the next hot tip. But overtrading racks up fees, taxes, and stress. The best investors are often the most patient. Think of investing like gardening. You plant the seeds, water them, and let them grow. Constantly digging them up to check progress only hurts the outcome. Some of the greatest investors, like Warren Buffett, hold stocks for decades. They let compounding do the heavy lifting. Not learning from mistakes. Here's the final mistake: not learning from mistakes. Every investor makes them. The difference between successful and unsuccessful investors is reflection. After every trade, ask yourself, what went right? What went wrong? What can I do better next time? Keep a journal. Track your decisions, your emotions, your outcomes. Over time, you'll start to see patterns. You'll learn what works for you and what doesn't. Investing is a skill, and like any skill, it improves with practice and reflection. So there you have it, some of the most common mistakes new investors make. If you've made any of these, don't beat yourself up. Every investor has. The key is to learn, adapt, and grow. Investing is a lifelong journey, and the earlier you master the basics, the better your results will be. If you found this video helpful, give it a thumbs up, Subscribe for more content, and drop a comment below sharing your biggest investing mistake or lesson. Let's build a community where we learn from each other and grow together. Thanks for watching, and I'll see you in the next one.